In our strategy, we use a phase framework. We are not predicting headlines. We track signals and sequence risk as the cycle evolves. This episode is about the difference between stress and cascade, not a crash call, but how instability turns into forced selling. We are reviewing a Eurodollar University breakdown of credit cycle stages. It focuses on how financial crises actually unfold. Go watch the original for full depth and context. The core idea is simple. Most crises unfold in 3 stages. Each stage represents escalation. A downturn is not a single event. It is a process. Timing and confirmation matter more than headlines. Stage 1 begins when investors notice something is wrong. They ask questions. They do not like the answers. When answers fail, investors ask for cash back. Money that once flowed in starts flowing out. This is the first real shift. Stage 1 can look stable because someone fills the gap. Often banks or large institutions step in. In our strategy framework, this still sits in an early risk phase. Markets can remain supported, but fragility is building underneath. The key divider is bank behavior. Stage 2 begins when backstops weaken, when funding support pulls back. If cash is demanded and funding disappears, assets must be sold. This is forced selling. Forced selling does not wait for good prices. It sells because it must. That changes market behavior quickly. Funding tightens, credit vehicles sell assets, prices fall and pressure spreads. Stage 3 is systemic spread. Stress moves beyond the original problem. The system feeds on itself. This aligns with late cycle risk in our strategy. Correlation rises. Optionality becomes critical. This is educational macro commentary only. It is not financial advice. The clean signal is not bad news. It is whether banks keep providing support or step away. We watch the transition from stage 1 to stage 2 closely. We shorten reassessment cycles. We remain process-driven. We do not treat early stress as a crash call. We do not abandon discipline. Confirmation still matters. Watch bank behavior, watch funding conditions, watch signs of forced selling. If forced selling appears, risk rises quickly. If it spreads, tail risk increases. If funding stabilizes, risk recedes. We do not need to be first. We just cannot afford to be late.